I'm about to show you 5 of the hottest stocks on Robinhood as we start February. Now, just because these stocks are hot on Robinhood does not automatically make these companies good investments, but it does tell us exactly where retail investors are putting their money right now. So today I want to separate what's popular from what's actually worth buying. So a lot of people will sit there and they will bid up these stocks because they're super popular, they're grabbing attention. But then we're going to walk through each of these stocks and see which ones would make sense for disciplined investors and which ones could be dangerous at the wrong price. Spoiler alert, everything is dangerous at the wrong price. Because in the stock market, popularity fades, but valuation always wins in the long run. Look, most investors only focus on what is going up right now. They see the S&P up, they see AI opportunities everywhere, they see stocks making new highs, and they assume that that means they need to be in on the action. So let's check out exactly what those investors are actually putting their money into this year. I was doing some reading recently and found this article by market analyst Bram Berkowitz. It breaks down the 5 most owned stocks on Robinhood as we head into 2026. And whether you love Robinhood or hate it, this data matters. Retail investors have more influence than ever, and this tells us where the crowd is putting their chips. The 5 stocks that made the list were Ford, which is one of the largest and most established automakers in the world, Amazon, which, unless you're living on a rock, you know for e-commerce, but they have an incredibly dominant and powerful and profitable cloud business. Apple, if you don't know what that is, iPhone, iPad, MacBook, what else needs to be said? NVIDIA, the GPU designer behind the AI boom you're seeing unfold. And finally, Tesla, the most popular EV maker in the United States with Elon Musk at the helm. Now I want to make note, I did not say the most popular EV maker in the world because they just got passed up by BYD in China. Now let me be very clear about this. This is not my list, and I'm not telling you to buy anything based on popularity. We're going to briefly discuss why retail loves these companies and what I'm seeing today as a value investor with almost 30 years of experience. I'm going to walk you through the story behind each business. I'm going to walk through the fundamentals, and then we're going to run them through our stock analyzer tool to figure out what price actually makes sense today. Because at the end of the day, investing isn't about following the crowd. It's about understanding what you're buying and not overpaying for it. But of course, that's difficult. Why? Because we don't know the future. We don't know what a company is going to earn. 3-4 years ago, nobody would ever guess that NVIDIA was making this much money today. Nobody would ever guess that Microsoft was making this much money today. Nobody would ever have guessed Amazon and all these other companies. Ironically, the one company that's doing worse today in terms of revenue, the one company that has lower sales, is Tesla. And that's the one that 4 or 5 years ago, everybody would said, for sure that company is going to be magnitudes higher. Isn't that ironic? So stock number 1, Ford. God, Ford is a name that retail investors instantly recognize, and the familiarity goes a long way when people are deciding where to put their money. It's one of the largest automakers in the world with iconic brands like the F-150 and the Bronco. What's attracted retail investors recently is Ford's shift away from chasing unprofitable EV growth. 2 other reasons that stand out to me on why retail investors love this one. First, the company pays a 5% dividend, which appeals to investors looking for income. Second, at just $14 per share, people can buy larger amounts of shares for less money, and it makes them feel warm and fuzzy to say, hey, I own 1,000 shares, I own 500, I own 200 shares of a company. And for those of you who've watched our channel for a while, you know that both of these reasons are bad reasons to own a company. But we will see how the price actually relates to value. And one final note. Management recently raised guidance and reaffirmed free cash flow expectations, signaling confidence in the core business. So here's Ford, guys, $13.85 per share, all-time high, $37.18. Guys, look at this date, 1999. $56 billion market cap, $3 billion in dividends paid, that's 5.3%. They had cash flow last year of $12 billion, 4.7 times free cash flow. No wonder people like it. Look at this. It's a buy by the members in our community. $56 billion market cap means if you bought all the shares in the market, this is what it would cost you to own every single share. But look at this. Enterprise value, $270 billion. That difference of $220 billion is all debt. That's a lot, especially when your cash flow is only $12 billion a year. Returns on capital, 2%. Yeah, 5 times free cash flow is awesome. 12 times earnings is awesome. Price to sales ratio, 0.3. Very low for a car, even for a car company. Man, this one's tough for me. Let's go look at the 8 pillars. Okay, we have a low PE. We have a low price of free cash flow. We have income growth. We have revenue growth. We have a decline in free cash flow. We got lots of debt. They've increased their shares slightly and bad returns on capital. Now, guys, I will say this. There's a lot of data here. So a couple of things is this might seem overwhelming, especially as I get into my initial comments on this. But I've made this very simple for you. I've created a PDF that'll explain all of these key metrics to you so you can be knowledgeable, be smarter than everybody else in the room, and brag to your friends when you sit there and start dropping these terms. But more importantly, I want us speaking the same language so you can understand the things I say. So click the link below. I will send you a PDF explaining all of these and how important they are. I urge you to do it because it's the way in which you're going to learn best. I look at Ford and I think to myself, okay, here's a business with lots of debt. Here's a business that's highly capital intensive, which means in order to grow, it needs to build factories. It needs to invest in tons of things. And they're doing a bad job of it based on their returns on capital. That return on capital means this is how much return they get when they invest in the business. You don't want to be investing in companies that don't get good returns on their capital. I'm going to say this is one of the lowest I've seen for a mature business. And it doesn't surprise me that the stock is down half since 1999. More than half, sorry, 66, 70%. That's insane, guys. That's a lot. Okay, so there's a good question that just came up from Tim, our producer. He said, CEO, he said, Paul, can these returns on capital get better because they're written off the write-off is done. These returns on capital are based on free cash flow. The write-off is not a cash flow hitting item. If they weren't doing well for that and it's going to increase their free cash flow, yes. The problem they have is this metric is based on their capital base. How much money is in the business through debt and equity. Look how much debt is on the business. $220 billion. And then unless they're able to really pay that down by massively increasing their free cash flow and paying down debt and do it, that's the way you either have to like 10x this cash flow or you have to pay down your debt by a huge factor. That's how you get, or a combination of both. That's how you get the returns on capital higher. So it has to be the business gets better and the balance sheet gets better or some combination of both. That's the hard part. So let's see what analysts think about this company. Well, they're pretty optimistic. $1.50 per share this year, going to $287 in the next 3 years. That's almost doubling. And sales going from $176 billion to $196 billion. Let's just for the heck of it, go back to 1999. In 1999, the company did $160 billion in revenue and profit of $7 billion. In 2024, they did $190 billion with 4 point. So who would have thought in 1999 that years later, their revenue would only be up 20% over 26 years and their profit would be down? All right, let's go to Stock Analyzer tool. Have I ever done Ford before? Let's look it up. I did back in 2022. Let's sit there and redo it though. I'm going to sit here and assume, first off, revenue growth numbers for the next 10 years. It's not been good. I'm going to go 0, 2, and 4. Profit margin, 2.25, 2.75, and 3.25. Free cash flow is way better, so that's good. So I'm going to do 4.5, 5.5, and 6.5. Now, PE and price of free cash flow. This is where it gets hard. Guys, I always tell everybody, start at 15 or 16, and then go higher for good companies, lower for bad companies. Guys, this is a bad company. Low returns on capital, no growth. Tough business, capital intensive. You're going to laugh at me when I say this. 7, 9, and 11. This is probably one of the lowest I've done in a long time. Now, based on those, I'm going to do a desired return of 9%. This doesn't mean I'm going to buy it for 9% return. It's just to figure out what my intrinsic value is with all these assumptions in there. What I actually recommend is having a much higher desired return. That's your margin of safety. So I hit the Analyze button. Here's what's interesting. Low price of 19, high price of 43, middle price of 28. That's very interesting, but it's a lot of debt. I fell for this on the Walgreens front. I thought, okay, Walgreens looks good, blah, 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 but it had a lot of debt, and you would have thought with all those great locations, it'd been fine. For me, I'm just not interested in Ford. It doesn't mean that you shouldn't do it. It just means that I'm not interested in it for me. Stock number 2, let's go to Amazon. Let's run through that real quick. Now, Amazon is one of those stocks that retail investors feel like they already understand because so many people use it every single day. It clearly runs the largest e-commerce marketplace in the world, backed by massive logistics and delivery network that would be practically impossible to replicate overnight. Not even overnight, over a long period of time. That's a big sign of a moat. Even if I gave you $100 or $200 billion today and say, go replicate Amazon, you would not be able to do it. This is an analogy I heard from Warren Buffett, by the way. And I like to apply it to sit there and say, okay, what would it take for me to go compete with Amazon? Guys, I'm going to go to extreme. I don't think I could compete with Amazon for $500 billion or $1 trillion. That's how embedded they are in our lives. And on top of that, AWS, Amazon Web Services, is one of the most dominant cloud computing platforms globally, giving investors exposure to the growth AI could drive. Now, it's interesting to me. When Amazon came out, they were selling books. And you always hear, and I talk about this all the time, focus on one area and dominate. Well, Amazon dominated by focusing on a lot of areas. They went from books to everything else selling. They went from selling stuff to selling cloud business. In fact, I remember hearing that Bezos was the only one that wanted to do the cloud business. It was his idea and nobody else wanted to do it. They do Prime Video, they do streaming, they do NFL. Like I look at it going, guys, work with what's your personality. And Bezos' personality was having lots of things going on. That's what worked for him. Now, retail investors are especially drawn to Amazon because it has not kept up with the rest of the Magnificent Seven, making it feel like a laggard with catch-up potential. Why? Because great companies go up all the time. Tariffs, margin pressure, and heavy reinvestment have weighed on the stock, but many see those as temporary issues rather than permanent problems. That combination of familiarity, scale, and long-term potential is why Amazon remains one of the most owned stocks on Robinhood heading into 2026. Amazon is a $2.6 trillion business, and guys, look at this. They have tons of warehouses, but look at their enterprise value, only 2.84. They have essentially almost the same amount of debt as Ford, but look at this. They've got $700 billion in revenue, $76 billion in profit, $36 billion in the last 5 years alone. Yes, their cash flow is down, but there's a reason for that. Their capital expenditures are a ton, why they try to expand. So I look at this going, same debt as Ford, way higher gross margin, 50%, higher bottom line margin, 11% last year. I just look at this automatically. Look at these returns on capital. Not great, but getting better, 6.35 to 8.49, because our returns on capital are based on cash flow, which is down a lot because of how much they're investing in their business right now. Every time they build a warehouse, that takes away from their free cash flow. And a lot of their capital expenditures is for growth and not maintaining, okay? So let's keep on going. What's the 8 pillars look like? Oh, all X's. Don't care. I mean, guys, their revenue, their free cash flow and profit, I mean, yes, it's an issue. They're selling for 240 times free cash flow right now. I'm going to ignore that because the free cash flow is down, and they're still selling for 34 times earnings. Is that high? Maybe. But guys, if their net income can grow 30% a year for the next 5 years and then 10% a year thereafter, that's probably pretty cheap. That's the big key I want you to remember. Let's go to analyst estimates. I mean, look at this growth in earnings per share from $8 to $14 in the next 3 years. That's 12%, 22, 30, and 11%. And revenue growth, guys, how does a company this big still grow revenue 11, 11, 12, and 10%? That's incredible. Incredible business. And this is a business I did not understand for a very, very long time. So now we're going to sit here and we're going to analyze Amazon. Let's pull it up in our stock analyzer tool. I'm your stock analyzer tool. Okay, so 10-year analysis, 4, 8, and 12% revenue growth. Might be aggressive, but I'm cool with that. Profit margin, I want to keep in mind here. I did 8, 12, and 16. None of these numbers have ever happened. So I'm giving it a lot of credit for what they're on their way to do. Just remember that. PE. What's the PE and price of free cash flow 10 years from now? Guys, I hate to say this. I put 20, 23, and 26. That could be low. Because I look at this company going, we're not going to be able to live without Amazon. You know, I look at the Warren Buffett analogy about Coke and Apple. And if you said to somebody right now, listen, you can't buy from Amazon for 5 years, what would you be willing to sacrifice to have that go away? Guys, I live off of Amazon. Literally, like every single day, if my wife even says, hey, PG, we need blah, 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 go right into Amazon and order it. If you told me right now, stop ordering from Amazon, I'd be like, oh boy. So that's an issue for us. Now, my 9% desired return, I hit the analyze button. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're gonna get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days, you'll see. This isn't gambling, it's common sense. Scroll down. I have a low price of 100, high price of 450, middle price of 226. Guys, it feels a little expensive now. I'm giving it more profit margin than they've ever done. So I'm just like, I don't know about this. I do have it on my watch list for 180, and I like that price, not to enter it at, but to be notified by the software so I can do more research on it and see if the price makes sense. And guys, stock number 3, Apple. They're obviously one of the most widely owned stocks among retail investors because it feels stable and dependable. Approximately 1.65 billion people use Apple products every single day, which gives investors confidence in the durability of the business. Beyond hardware, Apple generates a massive amount of recurring revenue from its services ecosystem. Retail investors are also drawn to Apple because of its capital discipline. Unlike many tech peers, Apple hasn't gone all in on aggressive AI spending, and that restraint has started to look smart as investors worry about whether AI capital expenditures will actually pay off. Or we could wake up years from now and going, that was the dumbest move in the world. The company consistently returns cash to shareholders through buybacks and dividends every single quarter. So the combination of brand power, cash flow, and perceived safety has kept Apple near the top of Robinhood's most owned stocks for a while. Guys, I have a great friend who I respect immensely. And a few years ago, he made a statement that I thought was wonderful. He said, whenever the next bear market comes, we'll be at or near the bottom when I see people giving up on Apple and saying you shouldn't even own Apple anymore. It will be the last chip to fall, in his opinion. And by the way, it makes a lot of sense because you have tech, you have reliability, you have a clean balance sheet, and everybody loves the products. So when people have given up on that, that'll be his sign that, okay, we're probably pretty close. $3.86 trillion market cap, $4 trillion enterprise value, half the debt of Ford, $112 billion in net income, 30x Ford, $100 billion in cash flow, 10x Ford, profit margin of 27%, gross profit of 47%. Guys, no acquisitions. I mean, it's incredible. Returns on capital, 58 and 62%. Everything here screams premium business, everything. And their 0.4% dividend yield eats up $15 billion in their free cash flow. Everything here screams quality. Here's their 8 pillars, everything we love. Just the valuation metrics. That's it. That's all we're looking at here. Analyst estimates. Wow, look at this. 11% growth, 10, 20, 14 according to analysts. That's incredible. And guys, if they keep increasing their revenue by single digits, but they're able to increase that revenue on software subscriptions, that's a big thing for them because they're starting to get in the high margin business of software. I believe there was a time not too long ago where their gross margin was 40%. Now they're at 46%. That means software is starting to make up more of their Apple TV and software, Apple One, et cetera. And then if they're able to take that money, buy back cheap shares, this could be a huge compounder, even if their market cap doesn't go up a ton. And that might sound weird, but if you listen to our channel over and over, you'll understand why that's amazing. So here we are, stock analyzer tool time. 10-year analysis. I did 3, 6, and 9% revenue growth. I did 24, 26.5, and 29% for profit margin and free cash flow. I'm good with that because their gross margin keeps getting better and their profit margin keeps getting better. PE and price of free cash flow. Again, 2023, 26 might be low. Amazon and Apple. I mean, how do you live without them? And then my 9% desired return. I hit the analyze button. I have a low price of 120, high price of 285, middle price of 187. So guys, I'm waiting a little bit on this one. This feels a little expensive to me. Warren Buffett's starting to sell a lot of it. So here is the big takeaway as we end this video. Just because a stock is popular on Robinhood doesn't mean it's a buy. In fact, it's a lot of retail investors who are highly emotional, so that makes me always apprehensive. And just because a company isn't making headlines doesn't mean it's a bad investment. Actually, quite the opposite. It's something to pay attention to. Retail investors can move stocks in the short run, but long-term returns are still driven by fundamentals and valuation. That's why we don't invest based on excitement. We invest based on what a business is worth and what price gives us a margin of safety. If you take anything away from this video, let it be this. Use the sentiment around a stock as information, never instruction. Let the crowd show you where attention is, then do your own work to decide if the opportunity is actually worth it. Now, if you want to see some companies that fit my process right now, I picked 7 stocks last year, my own personal Magnificent 7, to go against the market's Magnificent 7. And 2025 results were not what I expected, but I believe these companies are going to beat the Magnificent 7 over the next 5 to 10 years. And you're going to want to see how this all played out. So click the video on the screen right now. Thank you for your time.